assessment of the evolving macroeconomic and financial developments and the outlook, the MPC decided by a 4:2 majority to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF, rate remains at 6.25% and the marginal standing facility, that is MSF rate, and the bank rate at 6.75%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. So, in general, we have observed that the guidelines on key fact statement are followed, but a few regulated entities still charge fees, etc., that are not specified or disclosed in the key fact statement, that is KFS. It has also been observed that in some microfinance institutions and NBFCs that the interest rates on small value loans are high and appear to be usurious. The regulatory freedom enjoyed by the regulated entities in respect of interest rates and charges should be used judiciously to ensure fair and transparent pricing of products and services. The Reserve Bank continues its constructive engagement with such financial entities to safeguard the interest of customers and ensure overall financial stability.
That was RBI Governor Shaktikanta Das and some key highlights from what he had to say, including a bit of a warning as far as interest rates are concerned, but we'll get to that. Joining me now is Sajjid Z, Chinoy, the Managing Director and Chief India Economist at JP Morgan. Welcome, Sajjid. We've been on the RBI MPC policy since the morning, and I want to begin by getting you to tell our viewers, what do you make of the latest pronouncement?
I think this was very much on expected lines. I think with the recent growth surprises, the RBI is correctly very focused on inflation and bringing it to its 4% target. I think the best thing the RBI can do to support lower end consumption at this point in time is keep inflation low and stable. And by doing so, I think you can boost purchasing power at the bottom. Also, remember there are lots of uncertainties here. We're in a world with a lot of global uncertainty. It's unclear what the direction of global central banks is. We had 2 important central banks ease rates this week, the ECB and the Bank of Canada. But everyone's looking closely at what the Fed's going to do. And between now and August, you have 2 Fed meetings. The monsoon, fingers crossed, is supposed to be proceeding in plentiful this year. But the proof of the pudding is in the raining. And we also have a budget in July. So there's plenty of uncertainty for the MPC to simply parry things to August. For now, I think they're in a good place where growth is surprised to the upside and they remain firmly focused on bringing inflation back down to the 4% target.
Sajjid, amidst all the factors that you mentioned, including the budget and monsoon and US FOMC and other central bank decision making going forward, what do you think is the single most important event from an Indian monetary policy perspective, or is it a combination of all?
I think it's a combination of all these 3 things, but I would think, for the last year, what we've seen is if you break inflation down into food and non-food core inflation has softened quite materially. What we've seen in the last 2-3 years is food inflation, which is 46% of the basket, has been elevated and extremely volatile. So if you get a food price shock, either driven by the monsoon or by global factors, that can completely throw the inflation trajectory off course. So I would say while all of these factors matter, the fiscal stance, the monsoon, the Fed, I would think that getting food inflation under control is perhaps the most important. Interestingly, what the governor said today, and I agree with him here, is that the Indian economy doesn't have to move lockstep with the Fed. There are many other emerging markets which are more open, and therefore their monetary policy decisions are in a way held hostage to what the Fed is doing. What India has shown the last 4 or 5 years is because of the sheer quantum of FX reserves we've built up, we've been able to buy some degree of monetary policy independence. And you can simply look at that by saying India's policy rate, minus that of the Fed, which used to be 500 basis points in 2018, is down to 100 basis points. And that tells you that there is some policy freedom, some degrees of freedom, not completely, but some degrees of freedom. And I think the governor emphasized that today.
given that very important remark, Sajjid, do you think that the market should take this statement from the governor, a clear one of not having to always be in sync with the US Fed as a preliminary indication of a future start of a rate cut cycle? Basically, is it a pre-signal of sorts, Sajjid?
I would not read too much into that, because I think what the governor is stating is what's happened, over the last 2-3 years, where we've been able to deviate from the Fed. I think the RBI will remain very data dependent. So I think, let's wait and see how all of these three uncertainties play out in the coming weeks and months.
In terms of the macro construct and the outlook for the Indian economy, what did you pick up from the statement?
No, I think growth has clearly surprised to the upside, over the last 4-6 quarters now. And there clearly are areas where India's economy has been doing very well. At least 4 areas I can lay out over the last year. One is the big push on infrastructure. The center has been pushing for 3 years, but importantly, last year, the states also had a big increase in capex. So that's working well. The housing market, in contrast to China, is doing well, albeit driven by the upper end. But you've seen inventories come down to multi-year lows, so launches are picking up. So between housing and infrastructure, you're seeing a construction cycle underway. The governor alluded to the fact that credit growth is healthy, and that's a reflection of the health of the financial system. So that's a third driver. And then, of course, we've all discussed this new, exciting, emerging growth driver in terms of global capability centers. Right, and GCCs. And so, in a way, India has got these 4 autonomous drivers at play: infrastructure, housing, a healthy financial system, and the prospect of strong service exports. But I think the key kind of policy imperative over the next coming years is investment. That public investment has been doing a lot of the heavy lifting. And, at some point, this is going to come up against fiscal constraints. And so the baton will have to pass from public investment to private investment. I think that's the key going forward.
In terms of the private investment pickup, earlier over the last 3 months, or in fact slightly more, some experts say that they are seeing signs of an uptick. And I wonder what's your view on that? And would it also be okay for you to add a comment on what the RBI governor said in terms of NBFC interest rates? Because at some point of time, if there are to be curbs there, that is going to feed into lower consumption in some ways, Sajjid.
Let me just take the second part first. I think one of the most important objectives of the central bank is financial stability. And I think the RBI very correctly focused on financial stability. Credit growth is strong, but credit growth needs to be judged vis-a-vis nominal GDP growth. And to the extent that the RBI finds that there is excessive exuberance in some sectors, it's exactly right to be preemptive on that front. I think the one lesson that we've learned over the last 15 years is when you get excessive exuberance in the financial sector, you get these boom-bust cycles where you get boom for a couple of years, but then we spent a decade repairing balance sheets. So it's really important that now that balance sheets are healthy, that individual institutions don't get carried away. And I think it is the regulator's job just to, take away the punch bowl before the party begins. So I think what the RBI is doing in terms of financial stability is really important. As regards private investment, I would say, the good news is that the old constraints, the supply side constraints have now been alleviated. Like the banking sector, corporate balance sheets are in much better health. Profits have been strong in recent years. Corporates are sitting on lots of cash. The constraint now is not the supply side, but more on demand, right? And you can see that by virtue of the fact that capacity utilization numbers have been in the 74-75% range. Core inflation has come down to 3%, suggesting corporates may not have too much pricing power. You've got a lot of excess capacity in China, which is, being manifested through imports, not just in India, but countries as far away as Brazil. So in a way, I think the next focus has to be, how does India structurally boost demand, right? How do we get consumption growth to be stronger and more sustainable? How do we get exports growth to be stronger and more sustainable? So in a way, if you think of GDP as being consumption, investment, government spending, and exports, so far government spending has been doing the bulk of the heavy lifting. I mean, the coming years, as government spending retreats, Demand will have to come from consumption and exports. It's when corporates have that demand visibility, right, that I expect that you'll see a broader, more sustained investment cycle.
Sajjid, one of the hawks, and these are my words, in the MPC, Deputy Governor Michael Patra, in response to a question on whether rate cuts are now off the table given higher growth projections, said, we are not seeing signs of overheating in terms of growth. Nothing is off the table in context of a rate hike or a cut. What is he trying to say here?
I think this is the central bank speak for, all everything is always on the table. I think central banks refuse to take anything off the table, and as they should, Siddharth. I think, just look at the kind of poly-crisis world we live in. We're still in the midst of two wars. Commodity prices have been extremely volatile. Crude went up, has come down. Industrial metal prices are high. We're unsure about a hard landing or a soft landing at the Fed. We're reliant on the monsoon. We have a budget with the new administration. There are too many known unknowns, I think, for the central bank to foreclose any option. I think that was the simple point that the deputy governor was trying to make. But I will say that, we're still, India growth has been strong the last 3 years, but we're still, below our pre-pandemic path. Right, and so there is some slack in the economy, which is why core inflation has come down, and which is why I think it's important to structurally boost demand in the coming years through consumption and exports for private investment to respond.
Global inflation, and again this was something that the governor commented on, including that the final leg of the disinflation journey may be bumpier, it may be tough. Expand on that, please, Sajjid.
So I think what the starting point to all of this is, and this especially about the US, is that we've seen unprecedented resilience of the US economy. Remember, this was an economy that delivered a 10% of GDP fiscal stimulus. That it was not the deficit that was 10%, it was the stimulus that was 10%. And what that meant is that the private sector balance sheets were very healthy in the US. Now, the US was unique in that it has exorbitant privilege, and it can do things that emerging markets cannot do. But the strength of the fiscal stimulus meant that household balance sheets were very strong. Corporate balance sheets have been very strong. Household wealth, increase in US household wealth over the last 5 years has been close to $40 trillion. And what that's meant is, and a very tight labor market has meant that the US consumer has been humming along very well. And because you've seen such resilience in demand, the last mile of disinflation, if you look at where US inflation is on a momentum basis, it's running close to 3%. The Fed's target is 2%. It's that last percentage point that the Fed is after. Now, the US fiscal policy did the Fed no favors because US fiscal policy expanded by 3% of GDP last year. So you have a situation where the fiscal is expanding, the Fed has kept rates elevated to try and bring inflation down, and they're working at cross purposes. So I think what the governor is alluding to is that last mile in the US is proving very sticky, which is why there's no clarity or certainty about to what extent and when the Fed will start easing.
Absolutely, and there's a big election, one of the biggest in the world actually, in November in the United States. As far as India inflation is concerned, what did you pick up, if anything at all, about expectations for reaching 4%?
So I think that it's very important that we anchor ourselves to 4%. In the pandemic, inflation was averaging close to the upper end of the band, and that's what a flexible inflation targeting framework allows. That when you have a large, once in 100-year shock, and there's a scarring in the economy, then the central bank should be focused on growth, and be slightly more permissive of high inflation. But that can only go on for so long, and the RBI, I think, over the last 2 years has correctly pivoted. That now that the economy is recovering and progressively, recovering, that the focus should be on inflation. I think, inflation expectations matter a lot. So if the RBI continues to harp on the fact that 4% is their target, that will help anchor inflation expectations.
If the global rate cut cycle is turning, I don't know if you agree with that or it's showing signs of that, when do you expect the Indian cycle to turn, if at all?
In terms of growth slow, rate cuts, did you say rate cuts?
Yes, absolutely.
No, I think the RBI here is going to be, is going to look at both elements here, growth and inflation. Their growth number is strong for this year. They've increased it to 7.2%. Their inflation number is 4.5%, and so they can, at this point, have the luxury of, staying on hold. So, under what circumstances do you see rate cuts? Well, one is if we get a growth disappointment. Now, we'll have to watch the GDP numbers closely in the next few quarters because GDP has been very strong, but underlying growth of GVA has been slowing in the last 4 quarters, and it's unlikely, that gap between GDP and GVA is sustained. So I think one thing that the central bank will be evaluating in the coming months is growth tracking the 7.2% number? What is the outlook for GVA? And I think that will be a factor into decision making. Another is when, like the Fed, there is more clarity on inflation going to fall and staying there. So, 2 or 3 months from now, if the monsoon is plentiful, food prices come down, we don't have a global commodity shock, and the MPC has confidence that inflation is headed to fall, is going to stay there, that will open up some space for anything. So I think it'll be some combination of having greater conviction that inflation is going to go to your target and or being disappointed by growth, which will cause you to pivot slightly.
Since there's a 4:2 decision today, would that time where there is a majority view to begin a rate cut cycle be December this year, or are we looking at beyond that as well?
So that I'm not being facetious, but with economists around the world not being able to predict what the next US CPI number is going to be, or when the first rate cut in the Fed is going to come. Remember, we started the year with 6 cuts in the Fed.
Yes.
And then the market went to 1.5 cuts. I think there are just too many unknowns between now and December. I think the RBI will have to be data dependent and take it one meeting at a time, not pre-commit in either direction for multiple meetings. And I think by August, we'll have a lot of clarity, because by August, the budget is behind us. So the central bank knows the fiscal impulse. Hopefully the monsoon has progressed both geographically, and temporally well by August. And we'll have 2 Fed meetings between now and August. So we'll know very well what the Fed stance is.
Since you brought up the budget, I want to ask you, given that the most recent election results seem to suggest the need possibly of an administrative response in rural India, where there are some electoral reversals, what are your expectations from the budget? Will it continue to be inclined towards capex as it has been in the recent past, or do you see a mix of new focus, including social sector spending, for example?
I think this budget has more degrees of freedom than had been envisaged 6 months ago for 2 reasons. Remember, they started this year, we thought last year's deficit was going to be 5.9% of GDP, but the actual number that came out on 31st of May had it at 5.6. So we start this year with a lower deficit of 5.6%, and the target for next year is 5.1. So at the outset, that 0.5% of GDP consolidation seems eminently achievable. Secondly, the RBI has delivered a dividend that's twice as large as what had been budgeted. Right? So what was budgeted was 0.3% of GDP, and what was delivered was 0.6. So now, fiscal policy makers have got degrees of freedom on 2 fronts. I've got less to traverse in terms of consolidation, and there is an additional 0.3% of GDP. It's very unlikely in my mind that the capital expenditure thrust will be reversed. I think that process is bearing dividends. We need to continue with that going forward. So I think that will not be touched. But what that 0.3% of GDP dividend from the RBI allows the government to do is do more for revenue spending, right? So do more for current expenditures. Current expenditures, to be honest, were budgeted quite modestly. But with that 0.3% of GDP, you can have both capital expenditures and current expenditures. Now, there'll be temptation from bond markets to say, use that 0.3% to go even further, to take the fiscal deficit from 5.1 to 4.8. I'm not in that camp. Having over-delivered on last year's consolidation, which is 0.8% of GDP happened last year, and given the need that I said of structurally boosting consumption, right, and that has implications for employment, personally, I'd prefer to see that we do 0.5% of consolidation this year, which is still very credible, and use that extra dividend from the RBI to boost revenue expenditures in addition to the capex thrust that's happening.
Absolutely, and that boost in revenue expenditure will feed into several positives. Is that going to be the single most important thing that you will look forward to from the forthcoming budget?
No, I think this is more than that any one number. I think it's just the broader policy direction of the government. This will be the first big statement. I think there should be a lot of continuity. The question is what gets added on to what was done in the past. I spoke about the fact that several positives have happened on the supply side: infrastructure, banking, bankruptcy, the housing market. The question is, while continuing with that, can we also more structurally boost demand? And that will mean kind of focus on, consumption, employment, exports. These are multi-year initiatives. So I think the budget will hopefully lay out a pathway to that.
All right, Sajjid, that's a very important point for us to end this conversation at, because clearly the action now shifts to Raisina Hill, to Kartavya Path, to the new ministers, the finance minister and the entire council of ministers in terms of what it will lay out as Modinomics 3.0. Sajjid, thank you very much for taking out time to decipher what the mandarins of the Monetary Policy Committee have done and giving us an outlook for what to expect in the future. Thank you very much once again. With that, we slip into a short break. We'll be back with more. Do stay tuned in. Bye-bye.
As Narendra Modi gears up to take oath for the third time as India's Prime Minister, allies in the NDA camp are already piling pressure on the BJP. Nitish Kumar-led JDU has sought a review of the Agniveer, the new scheme implemented by the Modi government to induct soldiers, which gives only a 4-year term to 75% of the recruits.
Agniveer